The stock market has taken another nosedive. This has far exceeded anyone's expectations as to how far it can drop in such a short period of time. We are now officially in a bear market. This can certainly turn around, but it will take some major reassurances from the Fed of more liquidity or perhaps a TARP-type bailout. At this point, there doesn't seem to be any stopping this fallout. What will happen to US stocks? You came here for the truth, so let me unveil that for you. Today we're going to look at what has happened on the Christmas Eve trading session. I'm going to give you all the details, the technical analysis, the breakdown of exactly what occurred and what you need to know. Let's begin by looking at this article. Dow dives 600 points to below 22,000. S&P 500 enters a bear market. Worst Christmas Eve ever. I'll show you the details right now, just giving you an idea of exactly what occurred. On the right side, you see the S&P, NASDAQ, and the Dow Jones all in the red for the day. The Dow Jones actually dropped 653 points on the day, moving below 22,000. I wasn't sure it was going to get this low before having to come up a little bit and then fighting its way up and down, but you can see it's just basically been falling further and further, and that's not the only stock market that did so. You can see on the right hand side other markets falling as well. Treasury was not concerned about liquidity when Mnuchin called banks. You may have heard what happened, but essentially the Treasury Secretary, Stephen Mnuchin, called the heads of the 6 largest US banks. And what did he do? He asked, "Is your liquidity in check? Everything all good? Okay, thank you very much." This is nothing but propaganda. It's ridiculous. You make a few phone calls asking them if everything's okay. What does that actually do? Do you think they're going to tell you, "No, we got big problems. You better raise a red flag"? Of course, this is silly. And then they brought this information out to the public, thinking it would calm the markets, but that didn't happen. Mnuchin bid to calm markets risks making bad situation worse. And in fact, that's exactly what happened. And the question that is being asked right now is, what was Mr. Mnuchin thinking? So it goes into the details in the article, but that's what I really questioned. Is this part of a plan to stabilize the markets? Could that be? Because it had the exact opposite effect. Well, clearly it didn't work. So let's move on to what occurred throughout this period of time in which we have seen oil really taking a beating. In this one trading session, Christmas Eve, US crude plunges 6.7%. settling at 18-month low of $42 as the stock market slides. I've been tracking the progress of crude along with everything else, of course. You can see it actually at this point as I record. We are seeing WTI falling to $42.68 per barrel, and it's down along with Brent crude, who doesn't have much to fall to go below $50 a barrel. This has been just a massive wipeout in the markets all around the world. We can see today the S&P 500 being down more than 20% from the index's all-time highs on September 21st. A drop that size falls into the textbook definition of a bear market. Right now, the Dow and the S&P are on pace for the worst year in a decade. They began selling off sharply on October 3rd. What is going to happen at this point, we really don't know, but there doesn't seem to be any real reason for the stock market to go higher. I would say that according to the technical analysis, the market has sold off. In fact, it's oversold. So just for those traders, just for those algorithms, there may be somewhat of a positive push here. And that's not saying that there's anything good at all. It's just simply the technical analysis, seeing that it's oversold and buying in temporarily with the idea that they're ready to sell off at any moment's notice. I don't know if that's going to happen. Obviously, I'm not too bullish on the market at this time for many reasons, but that's what we're dealing with right now. We do think the equity markets are set up to continue this cyclical bear market or bear market, just call it what it is, and correct further, a deeper retracement. So that could definitely happen. I'm not an oracle. I don't really know, but that's where we're at right now. The worst is yet to come. Experts say a global bear market is just getting started. There's more details in the article, but essentially just wanted to show you that we could be entering into a much worse time here in the near future throughout the beginning of 2019 and beyond. This shows us the S&P 500 comp volume on the last session before Christmas, and right now they are at 3 billion, and that is far greater than any other time, and the chart goes back as far as 2009. That tells us that a huge amount of people were selling today, and it's not just in the S&P, but that's what they're using to measure the volume in this case. You've heard before about the treasury yield curve and how it inverts. Well, that's not the one indicator. There are many. And in this case, the 2-year less the 1-year treasury inverted. So yet again, this is another one that has done so. We haven't had this since 2008. But of course, there's a growing list of indicators that are showing us we haven't been there since 2008. That's why I call it the financial crisis part 2, because it's a lot of repeating patterns. And you can see the Japanese stock market falling by 1,000 points in a day. That's 5% down in one day. Massive deflation in their markets right now, falling completely in line with what we're seeing in the United States. The S&P Banks Index over the last few trading sessions has absolutely taken a beating. The plunge protection team hasn't been there to save the day. There are two charts interconnected with each other. You're seeing the S&P 500 consensus forecast. So imagine all the talking heads predict it's going to go one direction, and the actual difference in between that is huge, massive. In fact, it's the highest it's been. This chart goes back to 1998, and there's never been this divergence in between the consensus and the actual S&P 500, because people are thinking to themselves, where is it coming from? Why is the market declining at such a rapid rate? We don't have the dot-com issues. We don't have the housing boom and bust issues. We don't have all of the business that we did back in the 90s when things were looking terribly, back in the 80s, and so on. All these different factors that they're looking for aren't being triggered, and so they're thinking to themselves, well, it can't go down any further. It has to go up further from this point. I don't know what to do. I don't want to sell, and so on. So the euphoria, of course, got to their heads. This just shows us in the ratio format. So same thing, but in this ratio, we haven't been at this level since, guess what, 2008, 2009. Okay, we have two charts to show right here, just showing us the Fed Treasury holdings, which is the blue line, and then the change weekly, which is the yellow bar graph. And you're seeing that on top of each other. And essentially, very interesting to note that as the Federal Reserve is reducing their balance sheet, we start to have it affecting the markets. Okay, so take this information and add it to this, the Wilshire 5000, and you can see Treasury changes here moving into a negative territory right now since 2018, and in fact it was from the end of 2017. But you're looking at the Wilshire 5000, basically all of the US stocks is what that is, having a dramatic impact. Is it a coincidence? I don't think so. I really do not believe so. And we're seeing the effects of it today. The quantitative tightening cycle is in fact having a major impact on the US markets, and that is having a ripple effect on markets all across the world. So let's see what occurs over the next few trading sessions and beyond. If you found the video informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel, so I do appreciate that. And last but not least, if you want the financial education you were not taught in school, these two books have it all. You can actually flip through them at Amazon. There's a link in the description below, so definitely check them out. And if you're interested in the audiobook version, you can get that at themoneygps.com.